Okay guys, welcome to today's video. We'll be talking about marking liquidity zones and key POIs. Of course, we've talked about liquidity, what they are in the past, and we also talked about points of interest and how we can identify them. So I'll just be doing like a really brief recap on that, then teach some you guys how to mark out liquidity zones and point of interest. Now, you know what liquidity zones are, right? There are areas on the chart where orders are resting. This means where normal traders place their stop losses, buy or sell stops, and where they are pending orders, or where there are gaps, imbalances, price inefficiency on those regions. And common liquidity zones, like I've taught you guys, are equal highs, equal lows, previous daily high, previous daily low, right? Swing highs and swing lows, areas of consolidation, right? Then I also talked about point of interest and how to select them. Point of interest are key levels or are zones where you know that smart money would act. Either they want to continue a movement or they want to reverse price. There's just zones or areas you look out and you want to really observe. Like, you don't really care what market is doing, but you want to care more on what market is doing where when price gets to your point of interest, right? And that's a very important thing most traders don't know. They just frustrate. When you wake up, you have a routine. Smart money trader should have like a routine. You want to go to the chart and mark those levels, and you're not doing anything, right? You're not entering limit orders, you're not doing anything till you wait for price to get to that point of your interest. That's why it's called point of interest. It means you're interested in understanding what reaction price would make when it gets to that specific point. Okay, so that's what point of interest mean, and I explained what so many point of interest price can use in forms of order blocks, mitigation blocks, imbalances, after liquidity grab when price makes a shift, all those things, right? So a point of interest is just basically where you wait for confirmation, right, before you what enter a trade. So today we're going to be talking about how we can mark liquidity zones and those key levels. It's pretty simple because once we know how to identify them, then we can mark them, right? And identify liquidity zones. There's liquidity everywhere in price, everywhere, right? Because there's multiple, especially on different time frames. There's multiple swing highs and swing lows, multiple equal lows or equal highs. But we want to concentrate on higher time frame levels, which for marking liquidity zones, say the analysis time frame, right? H4, which is 4 hours time frame, and daily time frame where we use significant swing highs and swing lows, right? Those are where we want to really concentrate on. Okay, so for example, let's look at this chart. Um, this is XRP. Okay, this is XRP. We know, first things first, you know that when price moves high to low, what first the movement is what liquidity it means. Before price move, price should take a form of liquidity, right? Before price moves. So if you know that price moves after taking liquidity, right, what you want to identify is liquidity regions, then where smart money may be interested. So if there's a form of liquidity here and you know that price will take this liquidity, right, you need to now also identify another region which is your point of interest that is valid, right, where you know that if my price has taken takes a particular liquidity and price is coming, price would want to what, reverse from this area after what, taking a particular liquidity. So there should be a point of interest where you want to watch and see market reaction, right? Then you go in for your what, trade. That's how you should see the market. right? Nothing much, nothing less. Okay, now when you see market making moves like this, right, you see price creating different forms of point of interest, liquidity zones, voids, right? Let's go to our analysis time frame, 4 hours time frame, so that we see things clearly. Okay, so you can see how price is reacting from here. We know that this particular low, definitely this, for price to leave such region like this without taking it high, it means it's a liquidity level, right? Now we're just teaching you how to mark. It means whenever price is coming around this area, we don't know when price is going to come here, but we definitely know that this kind of low here are regions of liquidity that price, anytime you don't know, would still love to come and take out, right? Now you can see the reactions of price as it's moving, right? Price has taken out a form of liquidity here. There was no even structure break. Then it pulled up, took another one, pulled down. This guy took this one here, took this one here. Then immediately you can see price aggressively moving to higher regions, right? Tapped into a particular supply block here. We've seen a form of rejection, right? Till we confirm if price is going to move higher, because this region can also act as liquidity level if price is coming from a lower range of liquidity, right? We know that lots of sellers would have placed their stop loss just above this region, right? So if price is out to hunt liquidity, you might see a move, right, to take out a form of liquidity before you even get that reversal. Why? Because the last low that price swept, there was no really structure break. It means there was no candle close, right, below it. Definitely price would just want liquidity. If there's no candle low below it, and there's no really form of clear imbalances that price is leaving here, this high may be considered weak for price to take. It's different from this scenario where you have price having a form of inefficiency here, and price swept this one, and you can see how price targeted this inefficiency. So in this form, it's a form of what, from external range liquidity to what, internal, and from internal what, down to external, right? So that's how you read price. But in this case, no clear forms. You might be expecting market to take out a form of liquidity before any form of reversal. But if the structure goes up and closes, right, closes above this region, you know that, oh, after taking out a form of liquidity, we have gotten a break. So it's just a grab of liquidity, then a break of structure. We have identified how price does that grab, right? When you see price target a form of liquidity region, instead of after sweeping it, instead of rejection, it breaks above to continue the move, right? You get a continuation of the move. You cannot do nothing about it. At that particular point in time, price has decided to shift structure. You would take a loss, right? If you had entered the trade without confirmation, you would take a loss, but with the continuation, you would catch the move as it goes, right? So that is that. Then whenever we pick a key levels, if there's liquidity close to a point of interest, for picking key levels, we want to say whenever point of wherever we, or whenever or wherever whenever or wherever you select, if you're using the English, whenever you select a point of interest or wherever you select a point of interest, there should be a form of liquidity close to that point of interest. Now if it's an order block, you know you're gonna see a three candle movement, right? A three candle movement right there. You're gonna see three candle movement, right? And of course liquidity will be resting in form of an FVG on the second candle. That is a POI nearest towards liquidity. This now standing as a fair value gap, right? It means if market comes, taps into the fair value gap, fills it, and what sweeps the liquidity around those regions to complete the market, right, taps into your order block, you expect price to reject, right? Depending on the kind of trader you are and depending on how many times you have seen them move, You can decide to enter aggressively, or you wait for confirmation. For example, right? For example, this particular move right here, right? This particular move that price is making right here. Aggressive traders would have entered from here already. They are short at this particular place. What? But confirmation traders would wait, right? Why would you wait? You don't know, because price is coming aggressively after sweeping a form of liquidity, right? You don't really know if price will reject. For you to be sure if price will reject, you want to go to lower time frames to see, right? To see a pure or a clear market shift. Now, how do you know that market has created a clear shift? When you see markets taking out a particular low, right? Because if you are to calculate it based on swing, you have a high, a low, a high, a low, a high, right? This particular swing, I can even consider the entire swing low here, right? But while looking at that, you would also be considering a form of inefficiency that price has left here. If price would take out this particular low, right, something like this, if price will take out this low, it's meaning price may want to what, just make a slight reversal to this place for a continuation, which does not guarantee that shift, meaning market will still come and target highs, the price highs above this level, or price is just coming into lower time frame regions where it can make a particular shift from, which is here. That does not confirm the market going bearish. Have something like this, then all of a sudden price sticks out, right? So now what would a confirmation trader do? Confirmation trader would wait to see the structure completely shift, right? So they would want to see this low, right, completely taken out aggressively. And if this liquidity has been taken out aggressively, they'll be careful, right, because they know that there's a point of interest here. So what they would do is, if price comes aggressively, takes out this point of this liquidity and closes with a body, then while coming to this point of interest, leaves another sell side imbalance around here, it will be a confirmation that instead of us to maybe being a pullback, right, it might be a sell continuation to the downside. Why? Because we mitigated higher time frame point of interest that has not gotten broken, and coming back to fill this level before price moves higher, it means price doesn't want to go higher. It's just a shift, right? If it wants to really go higher, it would take out this region, say from here. Then if it's pulling back, I know that I am buying for a continuation, right? Now this is how you read price and enjoy it and mark out those key levels without stress, right? If you don't need to do much, all you just need to do is to wait, right? Once you have a point of interest and you're marking out liquidity levels, no need to start putting. I see some people, once they see structures like this, they start putting POIs, they start using their position sizing tool and start marking. You can't really mark it like this. Why? The reaction of price has not completed. We don't know if price is even coming here, right? You don't know if price is even coming here. You can see the way I marked it out. I say, okay, if the reaction is like this, when market makes a pullback from here and shifts up, comes back down, I'll be convinced that this level is going to hold for a continuation, right? Because the market rejects from here, right? Makes a pullback up without taking out this initial trend, right? Then this still bullish trend here takes out a particular point of interest that is on the sell side, right? But if I see a sell side pushing price down and I'm seeing a break of structure or a market structure shift on this particular trend here, any push from this point of interest that market has not taken out this region, firstly, any pull from this point of interest might just be a pullback for sales to continue, right? So this is how you read the market. Why? Because this strong supply zone is still holding, right? But in a situation where price takes out the sales supply zone, right? Then you're now waiting for price to come into the place. Beautiful. It means we have taken out that sell zone. I'll be targeting what? External range of liquidity, internal, right? This will now, this previous high will now be external. This point of interest here will now be internal, waiting for market to go and target it. This is how you see it. But now we are not even taking out the previous supply zone where sellers are selling from. So I would not be, so it means market is not ready to take out this stop loss. It sold aggressively, creates a structure shift. You'd want to target lower levels, right? So that's how you mark point of interest, mark kill. You do that on different time frames. You can do that on different pairs, right? Don't just be carried away by drawing multiple lines. Whenever you have a point of interest or liquidity regions, anticipate the market reaction, right? If market does this, then you do this. If market does this, then you do that. Okay, because we cannot really tell 100% what it's going to do, but we tell based on how it reacts close to that point of interest, right? If it does this, you do this. If you do this, you do that, right? So when you mark point of it, that's why sometimes you see me doing analysis. I'll tell you, oh, if we break this level, it means we want to go higher. If you cannot break this level and we tap into that level and go down below, it means we want to go lower. That's how it works, right? It's not something to drag about, to be looking at. Oh, no, 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 no. We don't really predict. We what react according to price. We react. We don't want to do those predictions. No, no. We want to trade and catch nice moves. Then there's situations whereby you come into the market and there are no moves. You don't panic. You're not meant to catch all the moves, right? There are good trading days, there are bad trading days, there are good trading weeks, there are bad trading weeks. Some weeks you might not even catch good moves, right? Some weeks you can catch moves, right? Depending on how the market plays out for you. Okay, so that's that for this video. Let me quickly upload it before the time runs out. So GM once more. GM, are you kidding? No GM. I'm not on Twitter space. So I believe you guys have learned one or two things from this video. You put it into practice, put it into action, and of course with time your eyes would get used to this reaction. It will be common for you, right? Then you'll be able to see good moves, right, based on the strategy you trade with. Of course, we are trading SMC. So that'll be all for today, guys. See you guys on the next one.